So here's a list of what I'm holding. Thanks, and I'll see you guys next week. Seriously though, last week I shared with you guys my past 15 years of history, what I went through, what I learned, and that hopefully gave you some context about what I want to share today. So if you guys wanted to hear more about the construction process of this portfolio I hold, stay tuned for the rest of this video. But before I begin, I really think there are some disclaimers that I really need to get across. Firstly, that this is a video for me just sharing my thought process. It is not a recommendation, nor am I suggesting that this is the portfolio that's gonna make you rich. It is not suggesting that my thinking is superior to others, nor am I suggesting you do the same with your portfolio. And finally, in case you didn't already realize this, I'm just a guy on YouTube sharing about personal finance and investing from his perspective. I am not a financial advisor, neither do I work in the industry. Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll save, invest, and feel better about money. So to start, I describe my investing process as closer to what you would call core and satellite. And that simply means that I have a core portion of my portfolio which I think about as almost permanent or semi-permanent, and then there are some satellites around it which I can swap in and out, but again my holding period tends to be long-term anyway. From a country perspective, I consider both USA and China as part of my core portfolio. So let's start with the three USA-centric ETFs. I hold SCHB at 18% of the portfolio, VBR at 14%, and AVUV at 18%. So why do I choose America as part of my core? There's not too much rocket science here. Historical gains have been great. You continue to see a lot of their companies being major impacts in the world. Heck, you're probably watching this on YouTube, so you get my point. And more importantly, we still see the world looking towards America as a place to invest in. And if you look at the scale of ownership of foreigners of US-based stock, that continues to grow over time. So why SCHB specifically? It is a total US stock market ETF which holds roughly 2,500 plus stocks within US. So I do prefer this more diversified approach rather than just buying the top 500 stocks in the US. So I'm aware of, and I've talked about VTI before, which is Vanguard's own version of the total US stock market ETF. Now, honestly speaking, they're both the same. And the reason why I'm using SCHB instead is that I used to be a Schwab customer. Therefore, I just decided to buy their products. Now let's get into VBR and AVUV, which are both small cap value ETFs, and collectively they form 32% of my portfolio, so it's a substantial amount. So here's my first reason. In my past videos, I've mentioned before these things called factors, and again super simplified, factors are simply aspects about stocks that explains their performance over a long term. Over the long run, between the 1920s till today, the factors that have shown to produce the best positive expected returns tends to be smaller companies as well as cheaper companies, which is why there is small cap value funds. Another reason that persuaded me was that last year there was a very interesting phenomenon where the factors of growth and value, which are basically on the opposite ends of the spectrum, the performance of growth outperforming value was so extreme historically that it felt that value should be able to return to the norm and catch up in terms of its performance. The additional reason to choose small cap value was that last year, when the entire economy was beginning to reopen after all that stimulus money was flooding the markets, small cap companies as well as value companies tend to benefit from what you call reflation, which is basically the whole kind of period where the economy is reopening and business is getting going again. So initially last year, I was holding on to VBR and SCHA. So I decided to replace SCHA with AVUV because at that point I discovered more about this company called Avantis, and basically the thinking and the people behind it were really interesting and reputable. In a nutshell, AVUV is a much more concentrated small cap value ETF. So if you compare the holdings, VBR holds about 300 more stocks than AVUV. And now the reason why I hold them both is that I'm gonna let them run and I'll see how it goes. Now, before I take a trip into China, I hope you take a trip down into the like button and click that for me, because that tells the gods of YouTube to share this video out with more people, and it really supports my channel's growth. Thanks. Why do I think of China as part of my core holdings? I hold CNYA at 9% and KWEB at 8%. I'm not including IEMG here yet, but if you include the Chinese portion of things, in total, I guess you'll be about 20-ish% of my portfolio in China specifically. So last year, I did a couple of deep dive videos specifically into China, so my thinking of that hasn't really changed. So if you wanted to dig really deep, you can check those videos out. But here are my summary points. First, they're obviously a massive country. But what's interesting is the size of their economy versus the size of their stock market. The gap is really remarkable, and I actually think that gap needs to close. And even though China's growth has been slowing of late, they're one of the few countries that are still growing at the pace they are. And if you compare that into the global landscape, yeah, it's hard to deny that they will continue to grow faster than most countries, including the US. And the final reason is that most investors are actually underweight China at this point in time. And there could be many reasons, and a lot of it is probably political, and I see that as an opportunity. So CNYA specifically gives me access to 450 of Chinese A shares. And if you dig deeper into the holdings, they represent what you would call the industrial side of China, whether you've got financial, consumer staples, construction, those type of companies. And that's exactly why I hold KWEB, which is a more Chinese tech/internet ETF. And within it, you've got the mega stars of the Chinese tech world. I'm sure you've heard of them before: Alibaba, Tencent, Meituan, all those guys. So I think these are a great way to kind of complement what I have with CNYA. So I've got a bit of the old economy, a bit of the new economy as well. Now let's move on to the three satellites that I have, starting with ARK, ARKK. Now, I'm a fan of Cathie Wood, so I like her style, I like her approach in setting up ARK Invest, and I like her entire thinking about investing in disruptive innovation and how, again, exponential growth in these type of companies are really going to be the future. So why only 7% of my portfolio in ARKK? So ARKK is all about really high/aggressive growth, and what it adds to my portfolio is diversification, because the other larger components are already tilted towards small cap value stocks. So you could say that my beliefs are that the US will continue to outperform into the future. Small cap value will give me the total overall performance edge, and on top of that, the growth element is the cherry on top, which might or might not work out. The next satellite is my emerging markets ETF, which is IEMG, which is about 12% of my total portfolio. Now, I'll admit that emerging markets as an ETF is really a weird one, because it contains so many different countries, each with its own unique issues and advantages. So it really isn't a very efficient way to kind of play this investment. Nevertheless, I'm comfortable using it for now based on these reasons. One, if you look at its holdings, it actually kind of covers a lot of the major big tech names of countries like Korea, Taiwan, and Hong Kong. Secondly, on a broad level, emerging markets countries tend to do better in an environment where the US dollar is weakening, and that's exactly what you're seeing right now. It's already fallen a lot, and my belief is that it will continue to fall even more into the future. And the final reason is that I'm simply not yet at the level where I'm comfortable making individual country bets. And the final satellite is PDBC, which is something that I would classify more as an intermediate term trade, but it's a fairly large one at about 14% of my portfolio. It's actually a broad commodities ETF that's built out of futures contracts, and it holds mostly oil/energy type of products, but on top of that has a mix of different other metals as well as agriculture as well. Now, the rationale for this holding is similar to the reflation narrative which I talked about earlier, where economies are reopening and there's a lot of supply imbalances that have not really been addressed. Now let me sum it all up with some points about how I intend to manage this portfolio moving forward. With the exception of PDBC, I'm comfortable holding on to all these ETFs for the long term. I'm comfortable with the ratios, but I might swap things out. So maybe like instead of KWEB, I'll get CQQQ. I top up every couple of months, and my style is very personal. I don't take my money and split it into all the ETFs. I'm very comfortable just looking at which is the right opportunity, because again, at any given point in time, there'll be underperformers and overperformers. So I'm going to be buying more of the underperformers instead. Or if I spot another specific opportunity, I don't mind trying to invest in that. For example, I am keeping my eye on maybe a precious metals ETF, or perhaps even an agricultural one. And the final point I want to make is to say that, hey, I'm human as well, and even though that this portfolio is kind of built for the long run, I still do struggle with fear and greed as well. And I think there's a lot of fear in the market. People are talking about US market valuations being very high. There's all these tensions between US and China. There's COVID fears and so on. So I'm just really trying my best to not let it influence my decisions too much. But yeah, that's my portfolio, guys. And if you have any questions at all about it, please feel free to leave it in the comments below and I'll get to it. Feel free to use it as an inspiration, but please don't take it as a recommendation of what to buy and how to build your own portfolio. So thanks for watching, guys. If you got value out of this, I would really appreciate your support in clicking that like, subscribe, as well as that bell button, because I'll be back again next Sunday as usual with a brand new video. And until then, you take care and keep playing your own game.